Hi, my name's Nick Griffin, and this is the March performance update and outlook video for the Munro Global Growth Fund. In this short video, we're going to give you a quick update on how the fund performed over the March quarter and provide some transparency to how that fund performance was achieved. And then secondly, we'll give you a quick outlook as to where we see markets ahead and how we have the fund positioned in the months ahead. Here we wanted to give you a quick update on how the fund negotiated what I'm sure you'll agree was a fairly volatile 6 months in equity markets. It's important to remember that the Munro Global Growth Fund is an absolute return fund, not a relative return fund. And consequently, we have some tools that we can use to ensure capital protection. On the left-hand side, we're showing you the net and gross exposure of the Munro Global Growth Fund over the last 3 years. And on the right-hand side, we're showing you the performance of the fund versus the index over the same period. And as you can see, the fund has held net equity exposure over 70% for a long period of time, enjoying strong absolute and relative performance. However, in October last year, we moved into capital protection mode, lowering both gross and net equity exposure as markets became volatile and uncertain, and ultimately choosing to completely cap the downside of the fund in December as markets got particularly difficult. As we now know, the Federal Reserve has since decided to dramatically pivot its positive stance in early January, and markets have recovered aggressively. The fund has put capital back to work and enjoyed strong absolute returns during the March quarter. However, the rapid nature of the recovery has meant the fund has suffered some relative underperformance over this period. But this is relative underperformance we are happy to give up in return for the comfort that our investors' capital was being protected, and most importantly, positive absolute returns are continuing to be achieved over the journey. And faced with similar set of circumstances again in the future, you can expect us to react in the same way again. So looking at the March quarter in isolation, what we're showing you here is the performance of a number of regional equity indices, the performance of the MSCI World All Country Index, and the performance of the fund. And as you can see, it's been a strong quarter for equity markets, particularly emerging markets, and also a strong quarter for the index. The index is up roughly 11.5%, and the fund has achieved an absolute return of 6.5% over this period. On this slide, we're showing you the same 6.5% split by FX return, option hedging, short equity return, and long equity return. And as you can see, long equities have definitely been the biggest contributor to fund performance over the quarter, and somewhat distracted by our option hedging and some of our short equities performance. As we move to the next slide, I'm showing you the same performance by region and by stock. And again, you can see the US has been the biggest contributor to our performance over the March quarter, and there have been a number of winners, all of them on the long side. On the detracting side, four out of these 5 detractors were some of our short investments. And I think from our point of view, it's somewhat disappointing that we didn't back off some of our shorts a bit earlier in the quarter. Moving on to fund performance since inception. As you can see here, in the short term, there has been some relative drag versus the index, but importantly, absolute returns have been preserved. And I think the key thing to focus on from our point of view is the 13.1% per annum return since inception, and something that we look to keep meaningful in an absolute return sense over the cycle, and that is what we continue to work towards. Moving through the next slide, what we're showing you here is just a little bit of outlook as to why markets have bounced so aggressively. And I think it's important to understand how dramatic the Fed pivot was and why it is so supportive for equity markets. So on the right-hand side here, we're showing you the US 10-year bond rate over the last 20 years. And as you can see, or as we now know, with the Fed moving to pause mode and then also stopping balance sheet expansion, the US 10-year bond has fallen quite dramatically, as has the German 10-year bond, as has the Australian 10-year bond. And what this does is this lowers the risk-free rate for markets. On the left-hand side, I'm showing you the S&P 500 earnings yield minus the US 10-year bond yield. And as you can see, this is essentially the equity risk premium. And the equity risk premium has gone up mainly because the risk-free rate has fallen so dramatically. This makes equity significantly more attractive and also has the dual effect of forcing savers out of cash and into risk, because ultimately cash is not providing them with adequate returns. And all of this is very supportive for equity markets in the short term and potentially in the long term also, if it can help engineer an economic recovery. We're now just showing you the fund as it was at the end of the March quarter. And as you can see here, our net exposure is back up roughly 80%. You will also see we continue to run put options in the portfolio should things turn difficult again in the short term. The top 5 positions haven't changed much over the last 6 months. Ultimately, all the capital protection we did was with cash or with put option exposure, but we did not change the composition of the portfolio through this period. The only other thing worth flagging here is we do hold 45% in US dollars, but are still over 50% hedged back to Australian dollars in line with our absolute return targets. But this also has caused some relative drag over the last 12 months. Finally, on the last slide, I'm showing you the Munro Global Growth Fund as we look at it by areas of interest. And here we're showing you how that money is deployed and the structural growth areas where we see strong structural growth in the years ahead. And here we see the digital enterprise is still our largest holding, at roughly 12.5% of the fund, with 6 holdings, of which Microsoft is the biggest. You'll also see a number of other of our key areas, whether it's e-commerce, emerging consumer, or internet disruption, are still very strong in the portfolio here. And I think the overall message here is that all of these companies, we see continued strong structural earnings growth in the years ahead, which should equal strong structural share price growth in the years ahead. And the lower interest environment only makes this more attractive. The last thing I'd say here is one of the bigger areas that has grown since we last spoke to you is the connectivity bucket at the bottom. And here we're very much focused on some of our 5G investments that we're looking for and a strong 5G cycle in the years ahead. And I encourage you to move forward to your next video and see Kieran Moore talk about some of our key investments there. Thanks very much for listening.